Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
So we got some good news for you and some bad news, and it's kind of the same thing. It just depends on your perspective. Here on this Tuesday edition of Wilmington Mortgage, I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the big stories that are moving rates every single weekday, or when I have the time to do it. and we do it in 15 minutes or less. You'd think I'd have 15 minutes every day to... You'd be wrong. All right, yeah, so we got some good news and some bad news. Basically, the bad news is that we have some troubling reports looking at the American consumer as we closed out 2025. We got some retail sales data that's a little troubling, some loan data, not mortgage loans, just overall debt, some troubling data. And so that could mean that the American consumer is running out of steam. And so therefore, the good news, we could see more rate cuts in our future or some looser monetary policy, which could mean better mortgage rates. And that's kind of how the market's interpreting things. I mean, it's pretty clear. So we got the 10-year was down about 5 basis points. So the 10 years now at just under 4.15%. And then we have the 30-year fixed rate index, Mortgage News Dailies. They have kind of like a floating index. And they have the 30-year fixed at 6.11%, down also about 5 basis points. So, like I said, American consumers' loss is potentially a home buyer's gain. And I mean, that's kind of funny. What's kind of funny about this business is that you want negative economic data to the point where it could mean lower rates, but you don't want the economic data to be so bad that it's going to impact people's ability to buy a house. So we live in this sort of like gray area where you don't want the American economy firing on all cylinders to the point where we do have problems with inflation, rising prices, and then all of a sudden rates have to rise. But you don't want the economy so bad that people can't buy a house. So we're like in that kind of gray area. That middle area is where we are. And so let's start with retail sales, because that was a report that got a lot of the attention. I think that is the cause of most of why you're seeing the decline in rates and the concern about the American consumer. So retail sales, December 2025. So we're still a little bit behind because of the shutdown. So normally you would get the December report in January. So here we are in February getting December's data. So we're still behind on data. They had sales flat in December. No growth from November to December. It was the second worst month that we have seen since June. And it was below economists' expectations. They were expecting a 0.3% rise. So a miss across the board. Definitely not good. No doubt about that. However, the real troubling part of this report, in my opinion, was the year-over-year data. So looking at December 25 compared to December 24, retail growth slowed to 2.4%. Now, it was 3.3% in November, so almost a full point drop off. So we not only are we seeing sort of a base effect where we had a month fall off from the year prior, but also the fact that we had a flat month, all created 2.4% growth. Now, that still doesn't seem too bad, right? 2.4% year over year. Here's the problem. Retail data is not adjusted for inflation. What was the CPI in December? 2.7%. So that means retail sales were not up 2.4%. They were actually down 0.3%, because if prices rose 2.7%, retail sales growth would also have to be 2.7% to break even. They were under that. So retail sales actually fell year over year. That's why we saw markets move the way that they did. That is a troubling sign, no doubt about it. Obviously, Americans were very concerned. It was like the number one talking point in the 2024 election. Here we are in 2026. It's still obviously a problem. American consumers do not like inflation. I mean, no one likes inflation, but we went so long without any real inflation in this economy that now that we're looking at, almost 3%. I think it's impacting people a lot more. And even though we were hearing concerns from consumers, we were not seeing it in the data. We were still seeing growth. Consumers were still spending. We just didn't see any evidence of this feeling in the data. And this could be the beginning of that. Now, once again, it could be an anomaly. Once again, this was the second worst report in the last 7 months. So there was actually a worse report. We had one that was actually negative a couple months ago. So could this just be an anomaly? Could this just be a fluke report? And then all of a sudden numbers are going to jump back up in January? Or is this a sign that the American consumer is at that breaking point, that they are pulling back their spending because they have to? And the markets are interpreting it as that, the latter, that the American consumer is slowing down. And you also saw that, and this is another reason why I think you saw the movement that you did. Maybe it would have been 3 basis point drop without the total household debt report that we got from the New York Fed. Now, this one wasn't as bad. You're seeing a lot of reports. I think whenever you get bad data, they always try and hype it up and say, oh my gosh, look how bad this is. It's not great, but I don't think it's as bad as a lot of people want you to think that it is. Doom and gloom sells. We all know that. I'm so optimistic. It's a problem. I'm such an optimist. It's hard for me to get any viewers on my podcast because I'm always talking about well, it's not that bad. People want to hear this is the end of the world. This is the worst thing to happen. So we did see debt grow to close out 2025. Total household debt rose by $191 billion to $18.8 trillion in the fourth quarter, according to the Federal Reserve Bank of New York. Mortgage balances grew by just under $100 billion. Now at a total of $13.17 trillion. HELOC balances jumped $11 billion to $434 billion. Credit card balances were up to $1.28 trillion. Auto loans were up to $1.67 trillion. Student loans jumped by $11 billion. And then we saw an $81 billion jump in other loan balances. So pretty much across the board, all aspects of borrowing money increased. Now, we like to focus, because this is Wilmington Mortgage, on housing mortgages. Mortgage originations picked up sharply with $524 billion newly originated loans in the fourth quarter of 2025, showing that that drop in rates that we saw towards the end of 2025 was actually pretty good. However, this is what was catching everyone's eye. Aggregate delinquency worsened in the fourth quarter. So you have 30 days late, 60 days late, and then 90 days late. And that's obviously you're delinquent when you go 90 days late. And so when I was looking at delinquencies, I didn't really see that big of a jump, but they were looking at sort of this aggregate delinquency, which I think was sort of looking at all the various stages, like 30 days, 60 days, 90 days. That rose to 4.8%. That was the highest level since 2020. And so that's what caught a lot of people's eyes. Oh no, this is the worst level that we have seen since 2020. But it wasn't. Now, once again, I was just looking at 90 days plus. So you're delinquent at this point. And we did see an increase, unfortunately, in mortgage and HELOC data. But in other areas, we actually saw a decline. So mortgage delinquencies were up 27%. But it's still, people need to remember how low it got. And so the fact that you see a big jump like that is not terrifying. We're actually just back to sort of a normalized level. You're always going to have some level of defaults. And the problem was in 2020, they disappeared. And so, you see these numbers and it's like 27%. Oh my gosh. The housing market's going to crash. No, we're now back to a normal level. HELOC delinquencies jumped 121%. Now, once again, number looks terrifying. But it's because we were at such a low level before that's why these numbers are jumping. And then student loan delinquencies, because remember, they just kind of brought back student loans. People hadn't been making payments for 4 or 5 years. And then the Trump administration sort of brought this, student loan. You got to start making your payments again. They jumped 2,200%. Because there were none. There were no delinquencies because no one was making, you didn't have to make any payments. You can't go delinquent if you're not making any payments. So that's why we saw that jump. However, auto loans, credit cards, and other consumer debt, their delinquencies actually fell. And so, I mean, to me, yeah, I mean, you don't want to see mortgage delinquencies rise, HELOC, student loan. You don't want to see any delinquencies rise. But the fact that probably your best indicator of consumer spending is credit cards, and the fact that delinquencies are actually falling shows the report's not as bad as some people want you to interpret it as. I'm not saying it's good. There's clearly an issue, and we're seeing that in the retail sales data. But like I said, it's not as bad as I think they are making it out to be. The retail sales, I think, is far worse than the debt data, because a lot of the debt data is just us returning to sort of normalized numbers, but doing it in a faster fashion because we were so low. So the increase looks bad, but when you look at the actual numbers, we're actually like at a normal level. And so that, I think, is where the misinterpreting of the data comes from. Intentional in some cases, other times just mistakenly not realizing that, you know, when you go 4 years, you kind of forget what normal is. You're like, this is the new normal. It's not. We're going back to, you're supposed to have some level. I mean, you don't want to have delinquencies. I'm not saying, yeah, it's good to have delinquencies. I'm just saying in a normal economy, you're going to have defaults. You're going to have delinquencies. You're going to have missed payments. And an economy that doesn't have any of those is just not real. We were living in this fantasy land for so long. So I think it's important to realize that the debt report, which I've seen a lot of headlines, oh my gosh, here it comes, here's the end of the world. Some people are hyping it just because they want to hype it for doom and gloom. But there's some troubling signs, but not that bad. Like I said, the retail report, I think, was actually a little bit worse of the two because of the fact that we're now seeing American consumers spending less when you account for inflation. So, like I said, American consumers' loss is potential homeowner gain. Because if, we get more reports showing, we're already seeing troubling signs in the labor market, which we're going to get more data this week. Tomorrow, we're getting the non-farm payroll. So we're going to see what that looks like. We got PCE at the end of the week, Fed's preferred inflation gauge. Those are some big reports. And if they're also problematic, like if we're still seeing high inflation, last week we got labor market data that showed a slowing labor market if non-farm. And, I saw Pete Navarro did an interview and he was like, oh, we got to start changing our baseline for the report because we're deporting so many illegals that the numbers are going to be worse. And so the fact that he's out there, actually, I don't know, does he work in the White House anymore? I don't even know if he does or not. I mean, he's obviously going to be hyping the Trump administration because he agrees with a lot of their economic policies. And so the fact that he's already out there kind of spinning the report saying like, oh, it's going to be bad, leads me to think it could be a bad report. And so bad labor market data, consumers not spending money, that is a recipe for lower rates. So like I said, bad news for the American economy, potentially. Good news for home buyers now with slightly lower rates. So I'll take it. So yeah, we got a big week coming up. Non-farm Wednesday, existing home sales on Thursday, and then inflation data on Friday. So strap in, get ready. We got more podcasts to do this week. So you guys enjoy the rest of your Tuesday. There we go. And we'll see you back here Wednesday for another edition of Wilmington Mortgage. Remember, as always, do not wait to buy real estate. You buy real estate and wait.